Okay, my dear buddies, shall we begin? So in the previous session, we had discussed income from house property and income from other sources, correct? So today, we shall be discussing capital gains. 6 to 10 marks pakka will come in the exam. 100% undoubtedly, very, very important chapter, okay? So like yesterday, it's a pretty big chapter, so we'll try to go fast. So if the previous session helped you, this also will definitely help you. Always keep chatting with me because I know you should be alive. You are alive, I'll know, no, that's right. So keep chatting with me. Keep, anything, whatever you have, problems, etc. You can, any doubts, etc. You can see. Audio, mic testing. Audio is fine only, Noda. Others, audio. I think it's fine from my side. It's very clear here. Right? All superb. Increase the sound. You increase your sound from your side. It's perfect here. It is quite, fine. No, it's clear, right? Very clear? Yes. Perfect. Yeah, even I am getting the perfect, sound thing here. I'm just checking. All right, guys, come on. Let's begin. So, income from capital gains. So, there is one of the, heads of income, as you know. So let's see. So in this session, quickly we'll revise chargeability, computation of capital gains, important concepts, transactions not regarded as transfer, capital gains on share debenture, slump sale. So many things are there. Quickly, whatever is possible, quickly we will discuss. Okay, come on. So for chargeability under capital gains, we have three things, my dear friends. One, there must be a capital asset. Second, there must be a transfer. Third one, there must be gain or profit. Only then capital gain will come, or gain will include negative also, loss, whatever it is. So guys, in the exam, always see whether it's a capital asset and is it a transfer. There are certain things. Transfer means what? Transfer of ownership, not just possession. Capital asset means what? We need to see. The law has defined what is a capital asset. So if you see here, any profits or gains arising from the transfer of a capital asset is chargeable to tax under the head capital gains. Pakka questions will come 6 to 10 marks, including exemptions, etc. Very easy chapter, right? It simply looks difficult. Income tax only looks very tough, correct? Looks very tough, but nothing is there in that. Very easy, very easy. If you respect the subject properly, it will also respect you back, and you can score superb marks in the examination, right? Come on. Meaning of capital asset is defined in 2 clause 14. Section numbers not needed for the exam at all. Not needed at all. Yes. So you see capital asset. Capital asset means property of any kind. Property of any kind. Property means what? Movable property, immovable property, tangible, intangible. Movable means like goods. Immovable means house. Tangible means something which can be seen. Intangible means what? Like your intellectual property, goodwill, what you cannot see. That will be generally called as the capital asset. Now, is goodwill a capital asset, or was there any amendment? All that we'll see. Don't worry. But does not include stock in trade, raw materials, or consumables held for the purpose of business or profession. If I have jewelry, some 1 crore worth of jewelry, is it capital asset? Yes. But if I have 1 crore worth of jewelry and if I am a jeweler, will it be capital asset? No, it will be deemed to be stock in trade. Now what used to happen was India is all made up of, if you remember, what is the economic barometer of the country? Stock market. Stock market, who will invest, my dear friends? You and I and all investing in small things. Who are the main investors in Indian stock market? You should know. Foreign institutional investors, and also, yes, the portfolio investors, foreign portfolio investors. Now the beauty is, when they were buying and selling shares and all, what used to happen was, in capital gain, it is what? Capital gain, it is 10%, 15%, 20% tax is there. PGBP, foreigners, 40% tax is there. So some assessing officers, what they used to do, they used to tell, no, you are selling shares and shares. Share is a, and you are holding it as stock in trade. Since you are holding it as stock in trade, I will charge business income. These FIIs and all went and stood in front of the finance minister. That time, I think, Chidambaram, Lungi man, Lungi man, Chidambaram. They said, hey, bro, what is this, bro? I am investing and you are charging 40% tax. Chidambaram said, sir, sorry. Then he inserted one line. What line? See, in case of foreign institutional investors or foreign portfolio, you can make it FII. investment in security in accordance with SEBI regulations shall always be considered as capital asset. See, I'm telling you, when we come to regular batch, no, each and every line I will tell you history. Now revision, everything I cannot tell, okay? History is there for every line, I'm not joking. And we will be studying from the Bear Act, only the Bear Act, okay? Bear Act means the law passed by the parliament. You leave that. So now, Chidambaram said, Anna, sorry Anna, okay, we will not treat it as business income, Anna. We will treat it only as what? Capital asset, Anna. Only capital asset will treat, okay? Sorry. Yes, so in FIIs, foreign institutional investors, whatever they sell, share, security, etc., always treated as capital asset. Always treated as capital asset. Even though the same is held as stock in trade. Beauty, right? So you should never forget it. Who did this? Sidhu Anna did this. Next. Personal effects of mobile nature is not capital asset. It is not capital asset. Like wearing apparel, furniture, my shirt. I sell this shirt. Capital asset? Bro, come on, right? So utensils, correct? In my house, my mom will throw and shout at me that, sambar she is making, she'll throw it at me. I will catch it. Capital asset it is? No, right? Utensil, vehicles held for personal use by the SSE. All these things are not capital asset. But my mother, Sunday I'll sleeping around till 11 o'clock. My mother will come and throw a utensil, full gold studded utensils, guys, full gold everywhere. That is worth some 50 lakhs. What do you think? Is that capital asset or not? We will see. So if you see Miss Zara, sold a BMW car for 90 lakhs, which was using for personal purpose, not a capital asset. However, if Miss Zara is using the same car for her business, capital asset as per section 214, as it is not personal effect because it's used for business. What are personal effects? It does not include, which means on these things, these are called as capital assets, for which capital gain will come. Jewelry, archaeological collection, drawing, painting, sculpture, any work of art. So I told you yesterday my work of art, one Mickey Mouse I will draw. And because I drew it, it will be sold at 10 rupees also, it will not be sold, but assume. Correct. If Walt Disney had drawn like this, the first ever Mickey Mouse that he created, and he's selling it at, let's say, 1 crore. Walt Disney's great-great-grandson is selling it at 1 crore. So Ramkumar, good question. NFT, non-fungible tokens, are they capital assets? My dear friend, come to CA final. We will do a taxation of VDA, virtual digital asset. Nirmala auntie has inserted VDA as capital assets. Later we will see that. Okay. If you want that knowledge, go to my YouTube channel, Punarvas Jayakumar classes. I have already released a video on VDA, virtual digital asset. Figure it out. I'll full everything I've explained if you are interested. Those who are interested, okay? Yes. So, drawings, paintings, sculptures, any work of art, yes, 1 CR. If I sell, is it capital asset? 100% capital asset. So, yes, capital gains will come. Now, jewelry, interesting to know. Ornaments made of gold, silver, platinum, etc. All these things are what? Whether or not worked or sewn into any wearing apparel. So if I have one shirt with all diamonds studded here, all this will be called what? It will be called as jewelry. It will be definitely called as capital asset. I told you my mom threw an utensil, full gold utensil, everywhere gold studded. Yes, it will be treated as jewelry. But silver utensils held for personal use are not capital. When relatives come, your mother will show silverware. Take silver plate, eat. So that silverware and all is not capital asset as per what? As per Supreme Court judgment. What about there was one Maharaja. Maharaja gave silver bar, silver coin, everything in front of Goddess Saraswati, and he was doing puja. Then when income tax officer came and told, hey, Mr. Maharaja, this is actually capital asset, he said, Poda. It went to court actually, and the court said silver bar, silver coin, bullion, etc. are not considered personal effect. Maharaja, it is a capital asset because it has come from generations together. That's how it is. Motor car used for personal purposes, even though you have claimed depreciation, is definitely not a capital asset. So you need to know in the exam, you should see what they are asking. If they are asking all these things, it is not capital asset. Okay. I mean, these are all jewelry. Sorry. These jewelries will be capital asset. It is not personal effect. It is not personal effect. Okay, my dear friends. Yes. So if you see, depreciation not been availed. Sorry. If it is availed, it goes into business. Correct. If it is availed, it goes into business. There different discussion we will do. Here, if the depreciation has not been availed, obviously, if I am using it for personal purposes, why will I claim depreciation? Okay, guys, very simple. But if I claim depreciation, then it will become a capital asset, then it will obviously, go into business, all that we'll see. Basically, if it's into business, it will go into the block of assets. So when we revise PGBP, I will discuss. It will go into the block of assets. Once it goes in the block of assets, will capital gain come? Today only we'll discuss that, but that block of assets concept you will understand in PGBP. Next, moving on. Immovable property is not personal effects. Obviously, immovable property will be a capital asset. I have a house. My girlfriend Sheila auntie gifted me house. Is it personal effect? No da. It is obviously what? Capital asset. Next. Agricultural land situated in rural area. Agricultural land situated. Now, what do you mean by urban area? What is rural area? You see this dialogue, you'll understand. If the population is less than or equal to 10,000 rupees, not 10,000 rupees, sorry, 10,000 people. Mornings I am talking about 10,000 rupees only came up. Okay. Population, people, less than or equal to 10,000, not rupees, 10,000 people. Then what is it? It is urban area or rural area? It is obviously cantonment board. What is it? It is obviously what? It is called as, if the population is less than or equal to 10,000, what is it? Rural or urban? Answer. Rural or urban? Less than 10,000, it is rural area. On the other hand, if the population is more than 10k but up to 1 lakh, up to 2 kilometers, what is it? Up to 2 kilometers, it is from that cantonment area, it is called urban area. Beyond 2 kilometers, my dear friends, it will be rural agricultural land. Similarly, if it is more than 1 lakh up to 10 lakhs, 6 kilometers you have to remember. Beyond 6 kilometers is rural area. Within 6 kilometers radius, it is urban area. Similarly, more than 10 lakhs for 8 kilometers. Any population in the cantonment board more than 10 lakhs up to 8 kilometers, urban area. Beyond 8 kilometers. So if the plot of land is here somewhere, population is more than 10 lakhs, it is here somewhere beyond 8 kilometer, then what? Rural agricultural land. And if the route and all is like this, full like this, it is route. I don't care. You should see what? You should see what? Aerial route. Aerial. From helicopter, they'll see, aerial. That route only you should see. That's all you should remember. So remember this, correct? Other things you will easily understand. So if you see, guys, everything is beyond 2 kilometers, beyond 6 kilometers, beyond 8 kilometers. Correct? That's what. So rural area means an agricultural land is situated in India or any area which is comprised of the jurisdiction, population of less than 10,000. Okay. So if it is 10,000 to 1 lakh, more than 2 kilometers, rural. Less than 2 kilometers, urban. 1 lakh to 10 lakh, less than 6 kilometers, urban. More than 6 kilometers, rural. More than 10 lakh population, less than 8 kilometers radius, urban. More than 8 kilometers, rural area. So if you see here, somewhere land, if it is here, it is beyond everything. So it is rural agricultural land. Got it? Come on, fist bump. Next. Urban agricultural land is treated as capital asset, obviously. So all these examples are there. Next. So next is gold deposit bonds. Gold deposit bonds was long time ago. It was inserted by, it was in 1970s later. Then Arun Jaitley came about with the gold monetization scheme. In the gold monetization scheme, what will happen? You will go and give your gold to the government. Government will melt all that gold and will make gold coins like that and keep specialized gold coins of 2,500 grams. They will make and keep separately. That, and they will give you interest. Now you have already transferred it to whom? The government. Okay. Government will keep this as a security in the in your world banks and get loan. Brilliant. So loan at lesser rate they are getting, and they are also giving you some 1.5% per annum interest. Whenever you want to redeem, they will give it back to you. Now, is this a capital asset? Generally, gold is a capital asset. But if you actually go for the gold monetization scheme, my dear friends, as envisaged by Arun Jaitley ji, then what is it? Is it called capital asset? No, it is not called capital asset. Gold monetization scheme, specified gold bonds, bearer band bonds, national defense gold bonds, all these things are not called what? Capital asset. Understood? Yes. I am trying to insert the logic also so that you'll remember. No mugging up. No mugging up any of these things. Everything has logic. Okay? Yes or no? All of you. Come on. Next, as I told you, any securities by FIIs which has invested in such securities, same thing. Then ULIP, unit linked insurance plan, to which exemption under 1010D does not apply. So under 1010D, if your amount of premium exceeds 2,50,000, correct? The amount of premium for any previous year exceeds what, 2,50,000, then in that particular case, that unit linked insurance plan, you will not get an exemption. You will not get any exemption at 1010D. So those unit linked plans whose premium is more than 2,50,000 per annum, that will be called as a capital asset, is what they are trying to tell. Very, very simple, right? So if you see, similarly, where a person subscribes to more than one ULIP and the aggregate of premium paid on all such policies exceeds 2,50,000, exemption shall be denied. However, these restrictions shall not apply to any sum received upon the death of the person. Very, very simple. Anyway, all that you leave. So if you see here next, it needs mention that the property should be a capital asset at what time? See guys, my great grandfather, when he bought one property, that was an agricultural land that time. So when he died, through will it came to me. But when it came to me, in and around it was fully developed. Can I go to the department and said, when my great grandfather bought it, it was agricultural land. So that same thing should continue? No. So if you see that the property should be a capital asset at the time of transfer in order to attract capital gains tax. So today if I am selling that land, I cannot tell it came from my great grandfather as gift. So even the nature of the capital asset will be agricultural land? No. In and around malls have been built. How is it agricultural land? So at the time of transfer you should see, is what they are trying to tell. The expression property includes any rights in or in relation to an Indian company, including rights of management, all these things. So capital asset also includes intangibles such as what? Copyright, trademark, patent, interest in partnership, leasehold, tenancy rights, route permits, right shares, and all these things. Just remember these things in revision. When we come to regular batch, each and everything, 2 minutes, 3 minutes, a separate explanation. Lou Mars means what? Basically, that also has a logic. Anyway, basically all intangible assets, including your tenancy rights. Tenancy rights is right to live, right to occupy your particular property, tenancy rights. So all these things, leasehold property. I have taken a property on 99-year lease. Am I the owner? No, but I can use it for 99 years. So all these things will be called as capital asset. Now, meaning of transfer. Two things were there. One is capital asset, second one is transfer. Capital asset, clear or not? Yes or no? All of you, come on. Maple Salunga. Hey. Come on, guys, all of you. Sir, who was speaking, sir? I don't know. Tell me. All of you. Yes, clear. Yes. Purinjita, Pakka, done. Super, awesome. You guys are super. Yeah, next. Meaning of transfer. One is what? Capital asset. Second one is what? Transfer. So transfer is what? 2 clause 47. In relation to capital asset, transfer includes, so it's an inclusive definition. Sale, exchange or relinquishment. Relinquish means to give up. Sale, exchange, extinguishment of any rights. For everything, I'll give you an example. Compulsory acquisition of capital asset, conversion of capital asset into stock in trade, maturity of ZCB, all those things. Let's see one by one. Exchange. Under mutual agreement, when two persons exchange ownership of an asset, so that is called exchange. I will give you my one capital asset, that is jewelry, you will give one more jewelry. So exchange. Relinquishment, I will give up my right to you, no problem. I'm not gifting you, but I'll give up my right for lesser amount. So I have a jewelry worth 1 crore, I'm selling it to you at a lesser rate. In the previous class we saw IFOS will come if I'm selling at lesser rate and all, but still less than the FMB and all we have seen. But it's okay, I'm selling at less. Is it relinquishment? Am I giving up my right? Yes. Relinquishment will also be, for example, when there is, reduction of share capital. So basically, my share is of 10 each. In reduction of share capital, what they'll do? They'll say, sir, please make it share of 8 each only. Though it is 8 rupees, please let go of 2 rupees, sir. You will learn it in accounts. In accounts, there's a chapter called internal reconstruction. Very good. Internal reconstruction. In that, you will learn. Okay. Now, this 2 rupees is what? I'm giving up my right. Okay. Yes. On the other hand, if there is redemption of preference shares, buyback of equity shares, in these cases, what happens? They'll take away my shares. No. In redemption of preference shares, I hold 1 lakh preference shares. Company will buy back those preference shares. Redemption of preference shares. Is my right there or not there only? Not there. That is called extinguishment of rights. That is called extinguishment of right. Is it a transfer? Yes. Will capital gain be calculated? Yes. So in the exam, please see. One fellow sold one asset. Capital asset, yes. So it is, what do you say? Transfer. Second, one fellow exchanged this asset with that asset. Both are capital assets? Yes. So capital gains will come. Third, part of the asset is given up, relinquished, yes. Then my shares entirely I gave it for buyback. Is it extinguishment? Yes. Next, compulsory acquisition of a capital asset under any law. In Chennai, there is metro construction going on. Bangalore, metro construction going on since years. God only knows when they'll finish it. What do you think? Is that also capital gain? Yes, that is also capital gain because it's a compulsory acquisition of a capital asset. Nothing can be done. Conversion of capital asset into stock in trade. So you have a capital asset, jewelry. Now you'll bring it into business. When you bring it into business, that is also deemed to be a transfer. ZCB, zero coupon bond. There is no interest on that. Everything else is exempt, whatever you're getting. But when your maturity proceeds, it will be taxed. That's why maturity at redemption of ZCB will be taxed as a capital asset. So if you see extinguishment of right, relinquishment, compulsory acquisition, yes. Mr. Manjesh owns 10 kg of gold and gold ornaments as a capital asset, converts 6 kg into stock in trade in his proprietary business, Messrs. Manjesh Jewelers. Portion of the capital asset being 6 kg which is converted into stock in trade shall constitute a transfer. Very, very simple. And transaction in which, for example, guys, you see, Ram enters into a sale agreement for transfer of his land for consideration of 1 crore to Sham. While entire sum agreed has been paid by Sham, possession also has been handed over by Ram, sale deed has not been executed. Always remember, only when the sale deed is done, only then transfer happens. But under the Transfer of Property Act, this is called part performance of the contract. Interesting to know that the moment possession has been transferred, correct? Part performance shall be considered as transfer irrespective of the registration of sale deed. The moment possession is transferred, that itself is transfer, right? So always remember, if they ask you anything about Transfer of Property Act, TOPA, under TOPA, part performance, the day possession is transferred, not ownership, the day possession is transferred with an agreement for sale, sale deed is not yet done, still it is deemed to be a transfer. All this in examination questions they'll keep asking, you should remember. And some cases, even though there is no transfer, is still deemed to be a transfer. Even though there is no transfer, is still deemed to be a transfer. Let us assume this speaker, I mean, let's say this is like a gold studded speaker. This is destroyed. I had insurance on it, 1 crore rupees worth. Assume this got destroyed in fire. When the fire got destroyed, is there a capital asset? No. Is this a capital asset? No. Why? Asset only is not there, no? Gold. Asset only is not there. What to do? But what happens? Insurance company will give some compensation. Is that deemed to be transfer? Yes. So law will assume certain things to be transfer. That is one example. So insurance compensation in lieu of destruction or damage to asset shall always be subject to tax under capital gains, even though there is no actual transfer. Did I give this to the insurance company? No. Did I give this to anybody? No. It got destroyed. Destruction also is transfer. Remember that, okay? Yes. Now in the previous class I told you, cooperative society is there. I own a house in the society, in the entire building. That building is taken over by society under the Cooperative Societies Act. They will issue shares. That share is when I am transferring the entire land. I mean my house there to the society. Is it a transfer? Yes, that is definitely a transfer. Above transaction is a transfer. So when he pays an agreed amount, the society hands over the possession to then later somebody else is buying. He will buy the house or the share. Will buy the share. Is it also a transfer? Yes. That's what I'm trying to tell. Then long term, short term. Very simple. This chart will help us. One is listed shares. Listed shares can be equity shares, preference shares. Units of Unit Trust of India. UTI. UTI in the year 2002, after the Ketan Parekh scam, UTI split into two things. One is administrator, one more is specified company. Both they can ask in the exam. Always remember units of UTI. UTI is no longer there now, right? Correct? It had become Axis Bank and all. Remember? Yes. Units of equity oriented fund, not debt oriented. Debt oriented will come where? Debt oriented will come here then. So if they ask you debt oriented fund, it is not covered in any of these things. Equity oriented fund and ZCB, zero coupon bonds. Only these four things. Less than or equal to 12 months short term, more than 12 months long term. Unlisted shares. Unlisted what shares? Equity shares, preference shares. Next, immovable property being land or building or both, 24 months. Any other capital asset? Any other capital asset? I buy shares of, let's say, Facebook, Mark Zuckerberg's Facebook. I buy shares of Tesla, which is listed in New York Stock Exchange. Answer. New York Stock Exchange. Answer. What is long term? What is short term? It is listed. It is listed. Answer. I buy Tesla shares in the US, listed in the New York Stock Exchange. Answer. 36 months, 24 months. Guys, that will be 36 months category. Why? Is it unlisted shares? No, it's not unlisted shares. Is it listed shares? Unlisted shares where? In India. Listed shares where? Listed in the Indian Stock Exchange. Please see all those things. Exam, they will ask all this. SSE transferred a share which he had in Tesla, which is listed in the New York Stock Exchange. Answer, 36 months. Got it? Equity oriented fund means what? It's a fund where they will buy, basically you will invest in that fund. It's like a mutual fund. That fund will invest in equity shares of other companies. Yes, and they will give you units. So basically you will hold many units in that fund. That fund will invest in equity shares of many companies and give you returns constantly. Very simple. Got it? So remember, Tesla shares, all other capital assets, 36 months it will come. Listed shares means Indian. If I buy shares in Reliance, it will come there. If I buy units of debt-oriented fund, answer. Units of debt-oriented fund, 36. Very good. Brilliant. 36. Got it? So this you please keep in mind. Regularly they will test in the CA inter-examination. Moving on. Now, on the other hand, when should I check? For example, land is held 10 years ago. Building, last year I constructed. So land separately I should compute. Building separately I should compute. For building it is short term. Land it is long term. Okay? Yes. And I should always see the period of holding the previous day. So if land was first held by the SSE on 18/11/2009, it will be long term by the end of 17/11/2021. Immediately previous day I should see. Previous day. All these are small hidden points. Keep that in mind. One day before I should see. Okay. Equity oriented fund. This you can go through. No, they'll not ask all those things. Yes. Format of capital gain calculation. Very, very important. Short-term capital gain, non-depreciable assets. Because, my dear friends, depreciable assets will go under PGBP. So, when I revise PGBP, that time I'll discuss. Okay. Here also I'll discuss little bit later. Capital gain on depreciable assets. We are just talking about non-depreciable assets. Full value of consideration, less expenses in connection with the transfer, net consideration I'll get. Then I should subtract what? Cost of acquisition, cost of improvement. And gross capital gains will come. Exemption under 54B, 54D will come. Net short-term capital gains. Ultimately, I should do. Long-term capital gain, non-depreciable assets. Full value of consideration. This. Now, guys, the second proviso to section 48 will come. What is that, my dear friends? Indexation. Since it's long-term, I cannot compare whatever I bought 20 years ago, 10 years ago, 5 years ago. So, the government has given a concept of indexation. Dairy milk chocolate, correct, 10 years ago for 10 rupees is not the dairy milk chocolate today, yes or no? Is obviously have to provide for inflation. 10 years later when you have children and all, They will tell daddy, daddy, mummy, mummy, I want dairy milk. 10 rupees if you give. 10 years later, how will dairy milk be? There will be one box full, chocolate will be there. The shopkeeper will put his finger and say, take, lick. That is dairy milk for 10 rupees. Correct? No, that's all. 10 rupees 10 years ago is not 10 rupees today. And 10 rupees will not be there 10 years later. 10 rupees dairy milk will not be there. They'll let dip finger, lick kappa, lick pa. That's all, 10 rupees. How what will you get? What will you get in 10 rupees 10 years later? Nothing. Right? That's why you should index it. Means you should bring it as if it is there today. Beautiful concept, indexation. Indexation benefit is only for what? Long term or short term? Only for long term. Only for long term. Very simple. Then you'll have all these exemptions, 54, 54B, D, EC, E, F and all these things. Okay. Exemptions are also very, very important for inter. 100% they will ask. 100% they will ask. Undoubtedly. Okay. Undoubtedly they will ask. Full value of, one they will ask a question. This question they can ask in the exam. I'm just telling. Anushka sold a land to ICICI Bank for its corporate office. The full value of consideration is 10 crore. Asset was acquired through loan from ICICI Bank only. That's the best part. While making payment of consideration, the bank adjusted the outstanding loan of 6 crores. So 10 minus 6 they did. 50 lakhs more discount to give, they told. And they sold it off, finally settled for 3.5 crores. Now, full value of consideration is 3.5 crores. Is it 4 crore or is it 10 crore? MCQ. Answer. What is full value of consideration? Come on, guys. Answer. Full value 10 crore, 9.5 crore, 6 and 6 crore. Always 10 crore. See, MCQ they can ask you. MCQ questions. Full value will have no adjustments, my dear friends. No adjustments. Absolutely no adjustments. Yes, the consideration is not ascertainable, FMV I should take. Valuation officer will come and all those things. Expenses in relation to transfer means what? Such as advertisement, brokerage, commission, incurred legal expenses, cost of stamp, etc. All this traveling expenditure, all that will be eligible for reduction. That is expenses in relation to transfer. Can I claim interest on loan also? Yes, interest on loan borrowed which has been allowed as reduction under income from house property again cannot be claimed here. House property I have already claimed, no? And 24th yesterday we saw, and after that interest portion also I have claimed. Again you will claim your expenses for transfer? No, not allowed. When the house is sold, of course. Cost of acquisition. Cost of acquisition is the price paid for acquiring the asset. So basically it should be indexed and all those. But if there is a gift, the cost will flow from the previous owner. Cost will flow from the previous owner. So for example, A gifts land to Mr. B, who again gifts the same to Mr. C. Mr. C transfers the land to Mr. D for a consideration of 1 lakh. In this case, cost of acquisition for computing capital gain should be whatever was A. He kept on gifting to me, no? Whatever he bought for, same thing, it will come here. Right? Yes. So, that is the thing. In case of following assets, see guys, though they are capital assets, cost of acquisition for this is nil. This you need to remember the list. Self-generated goodwill, cost of acquisition is nil. This was a Finance Act 2020 amendment. Logic, not needed in the revision class. There's a superb logic which can be linked to PGBP. Why it was made nil? With factual figures, I can prove it to you. Leave it now. Tenancy rights, LUMARs, bonus share. In bonus shares, what is the cost? It is just capitalization of reserves. So there is no cost only associated with it. Then all this trademark and all these things. Clearing rights, trading rights and all these things. So self-generated goodwill, it is nil. See here, yes, same. This also was the amendment. Then indexation. This is the indexation, my dear friends, for 22, 23, 331. You need to remember that. They will give this, all this in the exam, don't worry. So whichever year you sold it, if you are selling it this year, this you should take, divided by whatever year there it was acquired. Anything before 1, 2 is not to be taken. It should be taken from 1 to only 100. It is always 100. Correct? So if you see, if asset is acquired prior to 1/4/2001, cost or fair market value as on 1/4/2001, whichever is higher is indexed in case of long-term capital asset. So I should take FMV as on 1/4/2001 or the actual cost, whichever is higher, because the indexation concept came only in 2001 and 2. This in the previous class only we have discussed. In case of immovable property, fair market value as on 1/4/2001 shall not exceed stamp duty value as on 1/4/2001. What used to happen is this 1/4, this we didn't discuss yesterday, sorry, the other one, 110% we discussed, right? So in 1/4/2001, what used to happen? No, I mean, now if I sell, my dad had gifted me, or rather I had bought my property in 98, assume. 1/4/2001, the fair market value and stamp duty. Stamp duty value was 1 crore. Now I can claim more fair market value. My cost was just 20 lakhs that time. Stamp duty value is 1 crore. Stamp duty value is as per the stamp duty authority. Now I did one golmaal. Fair market value is done by a valuation officer. I go to him. I want to increase my cost or decrease my cost? Answer. To pay less tax. I want to increase my cost or decrease my cost? Decrease. Increase or decrease? Increase or decrease? Come on. I want to increase my cost. No. If I want to pay less tax, I want to increase my cost. I used to go to valuation officer, pay money. Bro, please bro. FMB, please bro, increase. No. This random fellow, it used to happen. This random fellow used to increase it to 2 crore, 1.5 crore, whatever it is. But stamp duty values as per the stamp authority, that will be perfect. Government was seeing, how come FMB is simply increasing? Then they know this SSC and valuation officer full friends. So they amended. They said, nothing doing bro. FMB, you do whatever you want, but it should not exceed what? SDV. Stamp duty value. If it exceeds, I will not allow. Stamp duty value is the final thing. Okay? Yes. Then you know how to get cost of acquisition, cost of etc. what you should do. But cost of improvement, only after 1/4/2001 you can do the indexation. Any cost asset improved prior to 1/4/2001 you should ignore. Very, very simple. So fair market value, yes, whatever it will fetch in the ordinary market, you should see. If I do painting, normal painting, then cleaning of the house, will I say cost of improvement? I hired from urban company. I hired for full cleaning of the house. I paid 5,000 rupees. Cost of improvement? Yes. No. So painting, regular keep etc. is not allowed. Definitely not allowed. This is interesting. Yes, where the capital asset was acquired prior to 1/4/2001, cost of improvement incurred after 1/4/2001 only can be taken into account. It was before that, whatever you did, ignore. You should ignore, no choice. Absolutely no choice. But cost of improvement made by previous owner shall also be considered after 1/4/2001. So, you see the example. This they can ask you. Hardik inherited land situated at Delhi through a will after the demise of his grandfather on 1/12/2014. Grandfather had carried out improvement by paying 20 lakhs during 2000. Again during 2013, further improvements were carried out by him, 5 lakhs. After demise of grandfather, Hardik Pandya incurred a sum of 10 lakh towards improvement. Now you see, in this case, cost of improvement prior to 1/4/2001 should be ignored. Cost of improvement in April 2013, 5 lakhs. That is, though my grandfather has paid, I will get the benefit. And Hardik, whatever 10 lakhs he had, that also will be taken. See, whatever happened in 2000, ignore. Got it? Simple rule, any cost of improvement before 1/4/2001 should be ignored. Cost of improvement after 2001 will be taken even if it is coming from some other party. Consideration is coming from some other party. That is who? Which fellow? My grandfather. Okay? Yes, that should be taken into account. General rule. What are the two things should be there? Capital asset plus transfer. When is the capital gain charged? Capital gain is calculated when? Capital gain is calculated in the year in which it is transferred. 100%. In the year in which it is transferred. Capital gain is calculated in the year in which it is transferred. But 4 exceptions are there, important. In these 4 cases, even though the transfer takes place in 1 year, capital gains is taxable in some other year. Sorry, I told capital gain, slip of tongue happens, right? So section 45(1)(a), capital gain. All Jain fellows don't come. I have a lot of Jain friends. Yes, section 45(1)(a), Michami Dukudam. Michami Dukudam. Yes, 45(1)(a), damage or destruction of what? Capital asset. Guys, I told you no, this got destroyed. What is the year of transfer? The day it is destroyed. Correct? What is the date of transfer? The date it is destroyed. Insurance compensation comes 1 year later. So when should I pay capital gain? Though it is in the year of transfer, capital gain will be paid in the year of receipt of compensation. Year of receipt of compensation. Second, 45(2), conversion of capital asset into stock in trade. Compulsory acquisition, then immobile property transfer in JDA. We'll see everything quickly. Insurance receipts received from insurance company will be, year of transfer is what? Previous year means assets were destroyed. But chargeability, when the insurance money is received. Insurance money is received. And what is the period of holding? Date of acquisition to date of destruction. Very, very simple. What could be the damage or destruction? Flood, typhoon, hurricane, cyclone, earthquake, Turkey earthquake, for example. Riot or civil disturbance, accidental fire in Gujarat earthquake that happened long time back in Bhuj. Asset has been destroyed by fire in financial year 21-22. Compensation is received from the insurance company 22-23. In this case, financial year 22-23 is the year of chargeability to capital gains, though the year of transfer was in 21-22. Yes, my dear friend, terrorist attack also involved here. Action by an enemy, whether with or without declaration of war. So, 26/11, that was not a declaration of war by Pakistan, but it was a declaration of war by the terrorist organization. So yes, Taj property, many things got destroyed. Cafe Leopold, anything got destroyed. Is it, 45(1)(a), will it apply for the insurance compensation? 100% yes. Got it? You see this? Jewelry, capital asset, previous year 1-2, cost of acquisition 10,000. Converted to stock in trade in the year 19-20. Correct? Actually make it 18-19. Converted 18-19, I'll make it because below they have given the same thing. 18-19, okay? Year of transfer is what? 18-19. I'm going to sell it in 21-22. The moment it is converted to stock in trade, this is the year of conversion. Correct? But when that is sold, when is it sold? 21-22. Sold for 50,000. Now tell me, income from PGBP is what, guys? 50,000 minus cost as on the date of conversion. FMV I should take 40,000. So 50 minus 40, 10,000 PGBP over. But when will I actually calculate the capital gain? 18-19 or will I calculate on 21-22? I should calculate in 21-22. Full value of consideration, how much? I should take FMB as on the date of conversion, 40,000. Transfer expenses not there. Index cost of acquisition, I should take which one, guys? This one, 10,000 into 18-19's indexation, 280 by 100, 28,000. So long-term capital gain, 12,000. Though this capital gain actually came in 18-19, I will not pay on 18-19. I will actually do it in 21-22, the year that particular asset is sold. And separately, I will also compute PGBP. Did you understand this concept? Yes or no? All of you, come on. Respond. All of you, come on, guys. All this can be exam questions, right? This Sunday, you should message me and tell, sir, paper was dead easy, sir. Evaluator will get heart attack, sir, seeing our answers. Yes, they'll be like, oh, what happened? How come all of these people have written so correctly? How is it possible? They should tell, right? Yes. Reverse. Conversion of, I am not setting paper and all that. Yes. Conversion of stock in trade to capital asset. Reverse. When stock in trade is converted to capital asset, now I was doing jewelry business, it was not working out, nobody was buying jewelry, correct? I was only gifting to Sheila auntie, Nirmala auntie, that auntie, this, and only gifting was happening. So what I did, I converted back to capital asset. Then FMB as the date of conversion shall be charged under the head PGBP, obviously. Reverse I am doing. And FMB as the date of conversion shall be treated as cost of acquisition for the purpose of capital gain. Reverse. That you leave. Next. See here. Jewelry converted to capital asset. I sold it on 50,000. Capital gains is 50 minus 40, 10,000. Period of holding is this to this, that's all. Whereas this one is PGBP. FMB as on the date of conversion, 40 minus, 10, 30,000. Right. Next, compulsory acquisition. Compulsory acquisition. So my house was there. Half house government took away, metro construction. So that time they can give me one award. Award can be initial compensation. Award can be later enhanced compensation, whatever it is. So guys, year of transfer, previous year means capital asset was compulsorily acquired. Let's say on 18-19 only they acquired, but when did they give me compensation? 2021. So when will it be actually taxed? 2021. Right? So you see, if the compensation is received in installments, entire amount of capital gain on such compensation is taxable in the year in which the first installment is received. Important. Suppose 20 lakhs is the initial compensation received in installments as follows. 15 lakh was received in year 21-22. 5 lakh was received in 23-24. The full compensation of 20 lakh will be charged in the year the first installment was received. Previous year 21-22. Previous year 21-22. Previous year 21-22. Got it? However, if any advanced or enhanced compensation is awarded, it shall be taxable as and when received. Remember in your mind, initial compensation, I don't care when it is received, it is taxable in the year, it is taxable in the year the first installment is received. First part. Enhanced compensation as and when received. Initial compensation, I don't care how many installments you paid. The day of the first installment, I'll charge everything. But enhanced compensation as and when you receive. Enhanced compensation as and when you receive. Right? So for that, your litigation expenses also you will get, because you will go to the court and fight. I said this compensation is not enough, peanuts, I want more. That expense also you can reduce. While computing the capital gains in respect of enhanced compensation, cost of acquisition and improvement shall be taken as nil because you are getting something extra, that's all. So if initial enhanced compensation, 4 lakh was initial enhanced compensation which was received in installments. 3 lakh in 21-22, 1 lakh in 23-24. Since it is an additional compensation, 3 lakh will be taxable in previous year 21-22 and 1 lakh will be taxable in 23-24. Did you understand, guys? Initial compensation, I don't care when you give. The day you give the first installment, full I will charge. Enhanced compensation, as and when you give, I will charge. As and when you give, I will charge. One extra thing they will ask. Sometimes an interim order is passed. Interim order means you will go to the court and say, sir, give me compensation, sir. Please, sir. I'll tell. Sir, please pass one normal order, sir, at least for some amount. Sir, I am claiming 40 lakhs. At least pay 10 lakhs now, sir. So they will pass an interim order. Final order can come anytime. Interim order they will pass. So, if interim order for enhanced compensation is passed in previous year 18-19 for an award of rupees 5 lakh, which was received, and final order was passed in 23-24 for an award of 8 lakh. Initially they gave 5 lakh, then added 3 lakh. In this case, 5 lakh was already received in 18-19. But it will be subject to tax when, guys? Only in the year 23-24 when the final order is passed. Always remember, if they ask you anything called interim order in the exam And they will also be, they would have given when the final order is passed. When will you tax this 5 lakh rupees? Though you received 5 lakh rupees in 1819, it will be subjected to tax only in 23-24 when the final order is passed. So 5 lakh tax will be in 23-24. They passed the order in 23-24 for 8 lakhs, of which they had already paid 5 lakh. Assume the remaining 3 lakh, though they passed the order in 23-24, that day only they will not pay. They paid in 26-27, 3 lakh extra. 5 lakh they had paid in 18-19. Final order they passed in 23-24. When did that remaining 3 lakhs come? 26-27. When will the 3 lakh be charged? Whenever it is received, that is 26-27. Are you clear, guys? Initial compensation, see the wordings in the exam. Initial compensation, you pay whenever you want. First installment, if it comes, means everything I'll charge. Enhanced compensation. If they ask you enhanced compensation, as and when you receive, you have to pay. But if they say enhanced compensation plus interim order, see these wordings. Interim order, if they give, then see, check the final order date. So interim order, whatever money you received, that money 5 lakh will be charged when you get the final order. But in the final order, money, if it increases, etc., that increased amount, whenever you receive that increased amount, 2-3 years later, you will receive. That time you will have to pay. Is this clear? Very important. Yes or no? All of you. Yes. Andiyan is asking. Hey. Yes or no? Clear? Right. Super. Awesome. Moving on. Ambi replies. Nandini? Yes, Nandini, I understood. Moving on, guys. Any interest that you receive on delayed receipt of compensation, etc., will be charged under IFRS. Previous class I told you, this we will do in capital gains. See. Very simple. And deduction of 50% will be given under 57. This is under IFOS, guys, important. Interest you will get. The compensation is 8 lakhs. Interest you will get 80,000. In that 80,000 will be taxed in IFOS, not 80,000, 80 into 50%. 40,000 will be taxed under IFOS. Very, very simple. So again, see, land building, acquisition, year of transfer, compensation received this year, 25 lakh, and additional compensation 3 lakh. So this is what you should do. You should, in the year you get additional compensation, you will pay 3 lakh. See, for that legal expenses nothing. Very, very simple. JDA, Joint Development Agreement. So I will have a land. One builder will come and say, bro, I will build one building here. I will build 4 floors, bro. 2 floors are yours, bro. And 2 floors are mine, bro. Apart from that 2 floors, bro, I will also give you 1 crore cash, bro. 1 crore cash I will give. Is it a transfer? Yes. When will tax be paid? You see? Chargeable to tax in the year in which the certificate of completion is issued by the competent authority. Generally, if the building is more than 8 flats, competent authority will be RERA, Real Estate Regulation Authority. RERA authority. Year of transfer, previous year in which the possession of immovable property is transferred. Very simple. Year of transfer is their possession is given, but when will you be taxed? Only when the certificate of completion is given. Very, very simple. All these things are fine. You see here. Mr. Shashank, a landowner, enters into an agreement in July 2020 with Bhavya Developers for developing a residential project. Shashank is entitled to 30% as a share in the project. Project completion was issued in August 22. Shashank transferred his share in the project in April 22. In this case, capital gains will be chargeable in the financial year 2021 itself. Even though completion certificate is issued in the financial year 22-23, this is if you sell it before only. This is a special case. In case the individual or HF transfers his share in the project on or before the date of issue of the said completion certificate, capital gain shall be deemed to the income in the year transfer takes place. The benefit of 45(5)(a) will not apply. This is an important thing. They can ask you this example also. We all told what? You hold possession and you will get the completion certificate, all close. Before you receive completion certificate only, I'll sell off. Then this benefit will not apply. This also can be asked in the exam. Right? General rule, Kunal is the owner. He sold in the JDA on 24/7/2018, date of transfer of possession. Cost of acquisition is 1 and 2. XYZ Builders completion certificate was derived when? 14/7/23. 3 flats in the project was given to Mr. Kunal. Right? Now, if Mr. Kunal sells one of the flats for 90 lakhs on 13/6/24, computation of capital gains. When? Computation of capital gains, first of all, for the previous year, 23/24, guys. What is the capital gain here? 3 flats I have received, first of all. At what rate? SDV 40 lakh. 40 lakh into 3 flats, 1.2 crore. Transfer expenses, nothing. Net consideration, same. Index cost of acquisition, 2 lakh. 2 lakh into when? Though the transfer is happening here. Taxability happens here in the year of completion of this thing, completion certificate, that is 23/24. So 1 crore 14 lakhs. Now if I am selling this again, how much I am selling? 1 flat for 90 lakhs. What is the cost of 1 flat? Cost of 1 flat will be this FMB. So 90 minus 40, 50. Understood? Again this example, understood? Cost of acquisition also changes. Cost of acquisition also changes. Cost of acquisition will be whatever fair market value you have taken. Yes or no, guys? Come on, all of you. Mic testing, check, check, check. Clear? Super. Next. So all these same examples are given here. Yeah. Next, moving on. Yes, full value of consideration on transfer of immovable property. So what used to happen was, I used to sell at dirt cheap rate. Though the value was 1 crore, I was selling at 20 lakhs, 30 lakhs, 40 lakhs. So one change came in IFOS. 56,210 they inserted there. One more change came here. Stamp duty value shall be treated as full value of consideration. Nothing doing, that will be the same. Then they came up with this formula. Yesterday we saw, no? Nirmala aunty. If your consideration, 110% of consideration, threshold value, stamp duty value. So if my stamp duty value is 100, or if my consideration is 100, stamp duty value maximum can be how much? 110. Right? So the SDV should be greater than 110% of consideration, then SDV will be the full value of consideration. Now you are selling at 80 lakhs, 90 lakhs, 70 lakhs and all those things, then nothing doing. Then what will happen? I will still put the SDV. But SDV is 100 lakhs. You are selling at 180 lakhs, 150 lakhs, 160 lakhs. So what your wish? So the consideration will be the FVOC. Consideration will be the FVOC. So the 10% threshold is given. But during the COVID period, I told you yesterday, COVID period, that 110% became 120%. 120%. So if the SDV is 100, if the consideration is 100, 110% will be 110. If your SDV is 120, 130, 140, you are still selling at less only. So you should have this as the full value of consideration. This was to ensure that no scams happen. That is what was done by the government. But as I told you, all these things will be possible if you obviously use the preferred mode, that is, credit card, debit card, net banking, etc. Account pay check, most important, account pay check, not cross check or bearer check. Then in the previous class already discussed this, I'm not going to do it again, but simple rule. I can go to the valuation authority. The valuation authority says 100 lakh. Stamp duty value is 90 lakh. So obviously I don't care, stamp duty value only will come. But stamp duty value is 100 lakh. Valuation officer says 90. Actual consideration is 80. Then in that case, this fellow, valuation officer's rule will come. Third, stamp duty value is 100. Actual consideration is 80. Valuation officer will make it 70. Like, bro, no. Valuation officer, you are too lenient. I will keep it as 80 only. I'll keep it as 80. Right? Let's make it like 90 or 90, 80, 70. Like that. So yesterday only we discussed in IFOS, we discussed the full thing. I'm not going to repeat it. Okay? Same stuff, no change. If any advance money is received, any advance money was received for the transfer of capital asset, but later it was forfeited as the transfer did not take place. So if you see any such advance amount received and retained shall be treated as follows: not subject to tax in the year of forfeiture. It is reduced from the asset. It is reduced from the asset. Advance money for an asset, it is reduced from the cost of acquisition. It is reduced from the cost of acquisition. Otherwise, if the negotiation did not result in any transfer, then I will charge it under income from other sources. It will be charged from income from other sources. So this again, it requires a lot of explanation with examples. Leave it. This is the basic thing in the what do you say revision. This is the best we can do. Anyway, so what about unquoted shares? Unquoted shares means what? Which are not quoted in the stock market, not listed on the stock market. Even if it is listed on the stock market, it is not traded frequently. That is the meaning of unquoted shares. First of all, it is not listed in the stock market. Second, even if it is listed, it is not traded regularly. They are called penny stocks, etc. So for them, what should be the what do you say, full value of consideration? Either the actual consideration or FMV. How will I determine FMV, guys? FMV you and I cannot determine. So it will be determined as per the valuation rules of CBDT. Valuation rules. The more in-depth version of the valuation rules, etc. predominantly are there in CA final. So we can check this, leave this now. But technically what they are trying to tell, it should be higher of the following. So if you see, one example I will give. Tarun acquired 100 shares of PJ Limited in 0405 at 5,000 rupees. Tarun Raj sir acquired 100 shares of PJ Limited. He transferred all the shares to Mr. Varun for 510 per share. FMB per share was 625, but he sold it for what? 510. 510. He is not Varun Raj sir. Tarun Raj, Varun Rani. Varun Rani sir. Okay. Next, full value of consideration shall be taken as FMB as on the date of transfer. So FMB is greater than actual consideration. So what is FVOC? 100 shares into 625. 100 shares into, I will not take 510, I will take 625. Right? This is the valuation. Actual consideration or FMB, whichever is higher. In the exam, they will only give you the FMB. Don't worry. You don't have to value all those things. So guys, again, I am telling you, we discussed that you need a capital asset, you need transfer. We understood what is capital asset, we understood what is transfer. And I also told you that taxability will happen in the year of transfer. Exceptions are there, 45(1)(a), 45(5), all that we saw. But there are some things, even though it is a transfer, it is still not a transfer. Like I will gift this entire jewelry to you. Is it a transfer? Yes, but still law says no, it's not transfer. Law says it's not a transfer. So this one, transactions which are not regarded as transfer. Distribution of a capital asset on total or partial partition of HF is not a transfer. HF will partition. And when they partition each apportion, it will be apportioned to each of those karta and the co-parceners. Even though it is transfer, it is not a transfer as per law. Transfer of capital asset by way of gift or under a will or irrevocable trust is not a transfer. I will gift you through a gift deed or will, my great grandfather will give, or irrevocable trust means the asset is transferred to you till you die. It cannot be cancelled by me. Only upon death it will come back to me. That is called irrevocable trust. In all these cases, there is not transfer. But what about transfer under a gift? If it is ESOP, is it transfer or not? Unfortunately, correct, it says allotted by a company directly to its employees under ESOP. So if you see transfer under a gift or irrevocable trust of a capital asset being shares. So what they are trying to tell is company gives employee stock option plan to employee. Employee gifts it to his wife. Ideally, this should be not transfer only, no? But unfortunately, since it is sent via ESOP, this gift is called as a transfer. ESOP are subject to capital gains. ESOP taxation is there. If you see, exemption shall not apply to transfer under a gift of shares allotted by company directly or indirectly to its employees. So if an employee goes ahead and gives it, it is subject to tax. So this is one exception you need to see in MCQ, other things they will ask. Then work of art, archaeological collection, all these things are not transfer. If I give it to a national gallery, if I give it to a National Geographic Museum, I will go give it to my Mickey Mouse, I will go give there. You please there keep this work of art. Picasso, PJ's great grandfather was Picasso. You please keep it. That fellow will commit suicide there only, seeing that amazing picture, right? So if you see, yes. So that is what we have to see. Okay. I think you are tired. I am tired because from morning I am teaching guys 12 hours over already. But it's okay. I am always extremely passionate. The eyes may be red, but the passion, heart is also red and pumping. RCB, at least we will win here. Correct? From morning I am teaching 7 a.m. 7 a.m. to 8 p.m. How many hours? 13 hours over. Middle some 10 minutes idli I went and had one coffee. Yes. Okay. In the above cases, come on. Cost of acquisition is what? Cost to previous owner. You see a gift taxation. Mr. Raj husband gifts the house to Mrs. Simran, wife. And Mrs. Simran will sell it to her boyfriend, Kunal. How much? How much? 80 lakhs. 80 lakhs. So now the thing is, the cost will flow from the previous owner, 5 lakhs. Correct? Cost will flow from the previous owner, 5 lakhs. So if you see guys, Mr. Kunal, full value of consideration 80 lakhs, transfer expenses nil. Correct? Then net consideration 80 lakhs. Cost of acquisition, how much? You see, 5 lakhs only you should take. 5 lakh into, which year you are transferring? 21, 22. 317 by 100. This is section 49(1). Cost will come from the previous owner. See this example. Then yesterday only I told you, holding company transferring to wholly owned subsidiary, provided the wholly owned subsidiary is an Indian company, exempt. Subsidiary company transferring it to holding company, which is a wholly owned subsidiary, and holding company is an Indian company, exempt. So if, for example, Tesla transfers something to Tesla Bangalore, Tesla India, wholly owned subsidiary, this is an Indian company, exempt. Reverse, Reliance company transfers to Hamleys. Hamley is a company, toy company registered in UK, but it's a wholly owned subsidiary of Reliance. That case, no tension, because it's between holding and subsidiary only, so it is exempt. All these things. During amalgamation also same thing will happen. Transfer of capital asset in the scheme of amalgamation by amalgamating company. Amalgamated company is not regarded as transfer if the amalgamated company is an Indian company. Same with demerger also. There are certain conditions. All the property should be the property of amalgamated company. All the liabilities should become the liabilities there. And the shareholders should get at least 75% in value of the shares. So A Limited is amalgamating with B. B Limited holds 20% of shares in A Limited prior to amalgamation. For the purpose of the above clause, shareholders holding 75% of more of shares in value out of that remaining 80% after deducting the shares of B should become the shareholders of B Limited. Then no problem. Same with exempting shareholders also. Demerger also same provisions. Yes. Conversion of bonds, debentures, debenture stock into shares will not be regarded as transfer. Debenture is a liability in the company. Basically, the company will issue debentures. It will be a convertible debenture. The moment it converts to shares, it is changing the nature, but still it is not regarded as a transfer. Debentures issued at 7% were converted to debentures issued at 8%. Debentures, the interest rate also changes. Conversion does not amount to transfer, no capital gains. 100 debentures of 10 each were issued at 5%. In 2014-15, 100 debentures were converted to equity shares of 10 each. This conversion also does not amount to transfer. And I told you, sovereign gold bond, when the time of redemption, government will give back. No, that is also not transfer. Then guys, these two, rupee denominated bond, government security. Tell me one thing, nobody will buy rupee denominated bond. Why will they buy? Because think about it, if any foreigner purchases something at $80 and $1 is 70 rupees, tomorrow he wants redemption of these $80 because he knows $1 will be 90 rupees later. But government now started issuing rupee denominated bonds. Government started issuing what? Rupee denominated bonds. Means what? Bro, nothing doing. I will issue bonds worth 10,000 rupees. If $1 is 100 rupees today, that is all you will get. Tomorrow, if $1 becomes 120 rupees also, you will get 10,000 divided by 120 worth money. That's all. I am not going to convert. Who will invest, guys? Nobody will invest. That's why what government did. Okay, bro, you please agree to this. When you sell that anywhere to another non-resident, capital gains will be exempt. Are you understanding the logic? I know you will not buy. Who will buy government security? No rate of return only. Who will buy rupee denominated bond? Nothing. So government came out with a plan. If you transfer normal shares of company only, I will tax you, capital gain. But if you buy this capital asset and transfer from one non-resident to another non-resident, full capital gains exempt. It is not a transfer. Understood? Understood the logic? They say you give me this, I will give you this. Give and take. Clear? No mugging up. No mugging up. You should not mug up tax. Everything is logical. If you mug up anything, you are lost. Similarly, conversion of preference shares into equity shares, etc. is not regarded as transfer. Reverse mortgage scheme. Reverse mortgage scheme was brought about by P. Chidambaram. P. Chidambaram, roughly around 2012-ish. 2009 to 2012, that range, he brought about this reverse mortgage scheme. So what is reverse mortgage scheme? Generally what used to happen was, parents had a house and they looked after their children. Children became big and they threw out their parents and they ignored their parents and they went abroad. Still, at the time of death, the parents used to give the house to the stupid children. Chidambaram said, nothing doing. They said, let the child go to hell. Let the child go to hell. They said, you dear Tata ji, party and Tata, no problem, you come to a bank. Bank will take over this property. Generally, when bank takes over the property, and bank will give you a lump sum amount. Ideally, when you are borrowing money, who should pay EMI? The grandparent should pay EMI. It's like giving a loan. Bank said, bro, no problem, bro. You don't pay. I will only pay. No problem. Your monthly expenses taken care. That's a reverse mortgage. You give this to me. No problem. This. When the house is transferred to the bank, not transfer. Got it? Reverse mortgage. When the house is transferred to the bank, not transfer. It is deemed to be not transfer. Any money you are getting here, not transfer. This is not called consideration. No tension. But when the grandparents die, when the parents die, children will come, no, my property, my property. Bank will say, hey, pay now. You left your parents and went, no, pay. You pay the full amount, whatever your parents I gave, and take the house. Is that a transfer? Yes, that is a transfer. Last, no, this part is a transfer. If they don't die, they can only buy it back. When they are buying it back, is it a transfer? Yes. What is not a transfer? House being deposited to whom? To the bank. Did you understand this concept, reverse mortgage? The liability of capital gains arises in the hands of the borrower on reverse mortgage only at the point of alienation of the mortgage property. Later. By the bank for further recovery, the only last stage it will come. Everything else it will not come. So 1043 exempts any lump sum amount. So they say this lump sum amount that I pay, not a transfer. EMI that I pay, not a transfer. You please enjoy. 1043. Very good provision. Bonus shares, cost of acquisition is nil. Why? You will not get anything to acquire that. You will not pay anything. Right shares. So right shares. Like in 2020, Reliance issued for every 15 shares of Reliance held, issued one right share. One right share. I remember the market price of one share of Reliance was 1,600, but the right share was issued at 1,300. When they give me this right to buy this one right share, for that there is no cost of acquisition. But I will now sell this right to somebody. I will sell this right at 100 rupees. So the person who bought this right, no, he has to pay me 100 rupees. He has to pay Reliance 1,300. Overall, he will pay 1,400. It is still lesser than the market value of the share. So is this a transfer? Yes. What is the cost of acquisition? Amount paid to the company. So for this guy, 1,300 is the cost of acquisition. When the rights are renounced, now for me, I have sold this right for 100 rupees. No. What is the full value of consideration? Renouncement price, 100 rupees. What is the cost of acquisition? Nil. Did I pay anything to get that right? No. Short-term capital gain. For debentures and bonds, guys, important, no indexation benefit. Only it is for shares, not for debentures and bonds. Then, rather than selling each asset by asset, what if I sell the entire undertaking? What if I sell the entire undertaking? That is called as slump sale. In the slump sale, individual assets I will not see. I will see the full undertaking. Transfer of an entire undertaking. If this undertaking is held for more than 36 months, long term. Guys, in that one asset may have been acquired 1 year ago, I don't care. In slump sale, I will take the entire undertaking. The entire undertaking is there for more than 36 months, long term. Less than 36 months, short term. Period of holding of the undertaking is also irrelevant. Period of holding of individual asset is irrelevant. Period of holding of the undertaking is relevant. That's what I told you now, right? Individual assets, I don't care. Full undertaking you should see. Now when you sell that, no, what is the full value of consideration? FMV of the capital asset on the date of transfer of undertaking shall be deemed to be the full value of consideration. Market value of the capital assets and market value of the FME of the consideration received or accruing by way of slum sale. So they will do valuation of all the capital assets transferred, or they will make the FME of the final consideration of monetary and non-monetary items, whichever is higher. What will be the cost? Cost will be the book value. Cost will be the book value. Right? So if basically net worth is a depreciable asset, WDV. Assets in 35 AD, because scientific expenditure have already claimed 100%, that will be taken as nil. Self-generated goodwill always nil. Other assets and liabilities book value. So if that is called net worth. So when I am computing the book value, it is coming up to 100 crore. There are some 30 assets. That is the entire undertaking. It's being transferred. Being transferred at 400 crore. This is point number 1. But I will do a valuation of all these 30 assets, and that is coming up to 500 crore. What will be the full value of consideration? FMB of the entire slum sale, or FMB of the capital assets, whichever is higher, 500 crore. And what will be the cost? Book value. What will be the capital gain? 500 minus 100. 500 minus 100. If individual assets, capital assets which I valued comes up to 300 crore, what is the full value of consideration? 400 crore. What is the cost of acquisition? 100 crore. 400 minus 100, 300 crore. Got it? Excuse me. Got it, guys? Yes or no? It is called slump sale. Slum sale. And since it is like overall value and already market value I'm already doing market value, indexation will not be allowed. Indexation is to bring it to market only anyway. So you guys will do all this. Chartered accountant. Capital gain when the consideration is not determinable means I will exchange one asset, you will give me one asset. So basically whatever the FMV of the asset that I will get from you will be taken as the fair market value. So he exchanged jewelry for shares. FMV of jewelry as on the date is 14 lakh. FMV of shares is 16 lakh. So in the hands of Mr. X, whatever is exchanged, 16 lakh will be taken. And of Mr. Y, 14 lakh will be taken. First proviso to section 48 and 115A again is to appease the non-residents. So non-residents were, I told you the same logic. If I sold something for 10,000 rupees, today the value of $1 was 80 rupees. Tomorrow the value of dollar will become 85 rupees, 86 rupees. Then the investment value will reduce in dollars. That's why they give a benefit of foreign exchange benefit. This is predominantly in CA final, you will get that. So average rate of telegraphic transfer selling rate and buying rate you should do, TTBR, TTSR. This question generally they will not ask here, they will ask in CA final. That's the first proviso. Now coming to exemptions. Very, very important. 100% will ask in the exam. Section 54. Directly we will see here. Mr. Raj sells what? Residential house property. Proceeds of capital gain, he has to invest in one more residential house property. When should he do it? Either 1 year before the date of transfer, or he should purchase 2 years after the date of transfer, or he should construct within 3 years one more residential property. If it is not done, I should deposit in capital gains account scheme. When? Before the due date of filing the return. Only then you will be getting the exemption. But there is a catch. This property that you purchase, there is a lock-in period of 3 years. If you have transferred it within 3 years, whatever was exempted before will be withdrawn. Correct? Very, very simple. So it should be very simple. Long-term capital gain, selling one house property, buying one more residential house property. Next. 54B. Neatly this chart is there. No tension. Everything is explained here. Raj individual HF sells urban agricultural land. Urban land, not this thing. What do you say? Not our rural land. Proceeds of the capital gain, so you should invest or deposit in one more urban or rural he can buy. Selling should be urban. What should he buy? Urban or rural? And this urban agricultural land should have been used by the SSE or the parents, not just kept there. Should be used. And you will buy one more urban or rural agricultural land when? 2 years before the transfer or 2 years after the transfer? And if you don't do it, again deposit in capital coin account scheme before the return filing date. Should be utilized. If it is not utilized, exemption withdrawn. Lock-in period. Property cannot be transferred for 3 years. If again transferred, capital gains exemption withdrawn. 54B. Next. 54D. Raj Limited. Or let's see, compulsorily acquires an industrial is acquired. What? Land and building. It is for all SSEs. There is a compulsory acquisition of industrial land and, his land basically has been compulsorily acquired. He will buy what? Another industrial undertaking. And the proceeds of that capital gain should again be in one more industrial land and building. Point number 1 applies to all SSEs. Point number 2, what should be the asset? Industrial land and building. Point number 3, what should he buy? Industrial land and building in some other area. When this industrial land and building should have been used for industrial purposes. And when should I buy? 2 years before or 3 years after? Whenever. Otherwise, same. Again, what should I do? I invest in the capital gain account scheme. And that will not be transferred for 3 years, lock-in period. When should I deposit in the capital gain account scheme? Before due date of filing the return. Again, if I don't deposit and not utilized, withdrawn. Similarly, within 3 years, if I sell that new asset bought, gone. So, in one area, my industrial land and building has been compulsorily acquired. And that I will buy one more industrial land and building in some other area. That is 54D. 54EC. All SSEs. What will they transfer? Immovable property. Proceeds of the capital gain will be invested in government bonds. Maximum amount is 50 lakhs. When should you do it? Within 6 months after the date of transfer. Before is not there here, only after. That bond is a lock-in period of 5 years. If transferred, then capital gains exemption. Otherwise, withdrawn. Withdrawn. In this capital gain account scheme and all is not there. 54EC, capital gain account scheme is not there. Thank you, Da. Thank you. I hope the charts are very easily understandable. Yes, that's why we made these charts. 54E, 54EE. Here only we can see. Long-term capital asset. Nature long-term. What should I buy? Specified units before 1/4/2019. This has become irrelevant now. It should be issued before 1/4/2019. There also 50 lakhs you will get. Leave it. This generally they will not ask. 54F again important. In all other cases, you will have to invest the capital gain. You see? Amount of capital gain invested. Purchase of new asset using amount of capital gain. New house property. Yes. Everywhere it is what? Amount of capital gain, but that is only exempt. Here in 54F, 54F it is different, guys. Here, net consideration must be utilized, not capital gain, net consideration. Most important, 54F. Net consideration must be utilized. So see here, 54F deadly. Mr. Raj. This is applicable to individual HF. What does he sell? Any capital asset. Land, jewelry, bonds, building, other than house property. Proceeds of net consideration is invested, not capital gain. Proceeds of net consideration is invested in another residential house property in India. I am not selling house property. In 54, sell house property, buy house property. 54F, sell other than house property, buy house property. Same, purchase 1 year before, 2 years after, or construct 3 years after another residential house property. Invested in what? Same, residential house property in India. Very important. I will compare with 54. In India is not there. 54 you can buy abroad also. MCQ. Are you understanding the hidden points? Are you understanding the hidden points? There's some problem with this. 1 second. Yes? Yeah. So in 54, this thing, section 54, it only says what? It was, India was not mentioned there. That's why later they added it. That's what I'm trying to tell. Got it? These were the hidden points. That's why they added it later. That's why I've given in the note. That's why I even told you now. Okay? Come back. See? Made the same. Check again. 1 year before, 2 years after. Date of transfer, 3 years after. Residential house property in India. In India, outside India, and finally we will explain more in depth. For inter, not required. I am just trying to explain what were the loopholes, what was plugged, all that. For you, just a basic understanding. Should try to read the Bare Act. That's why everything you will understand. Don't worry. When you come to final, we will do all that. Right? So 1 year before, 2 years after, 3 years after. Residential house property in India. There are some more hidden points in India, outside India, not relevant for inter, leave it. For inter purposes in India, okay, in India, inter purposes, okay. So investor or deposit rate, where capital gain account scheme, same thing. Property cannot be transferred before 3 years. Transferred, capital gains exempt, same thing. See, if the net consideration is fully utilized, capital gain is fully exempt. If net consideration is partly utilized, CG is partly exempt. Very simple. You should fully utilize the net consideration. Otherwise, the long-term capital gain is 10 lakhs. Cost of the new asset is 8 lakh. Net consideration or the cost of the new asset is 8 lakh. Net consideration that you have used is only 6 lakh. Only that much you will get. Full net consideration you should use. Sorry, 10 lakh, and the cost of new asset or deposit amount, cost of new asset is, let's say, 16 lakh, and the net consideration is 20 lakh. So you should use the full net consideration. If you use it less will be allowed. Cost of new asset also will come down. One more condition, guys. To avail 54F, one more deadly condition. SSC should not own more than one residential house property other than the one acquired in this section, which means you should have one more. That's it, maximum. Not more than 1, which means 1 plus 1 you should have already had. It's okay. Maximum allowed is 2. An assessee should not purchase within 2 years or construct within 3 years any other residential house property apart from this. These are the 2 conditions you should do as on the date of transfer. Some hidden points. Important. So section 54 and 54 at cost of land acquired by C will also be eligible for exemption along with the cost of construction. Obviously land also you should take. Date of commencement of construction is not relevant. Construction could have been started before you sold the asset also, but it should be completed within 3 years. Option of investment in 2 residential houses subject to certain conditions only applies to section 54 and not 54F. Because one more, in 54 you can buy once in a lifetime 2 houses. Instead of 1 house you can buy 2 houses in section 54. That was an amendment. To claim exemption under 54, purchase of residential house coupled with possession is a precondition. Not just purchase but also possession. Registration is not necessary. They will ask all this in the MCQ. The assessee purchased one more property within 2 years, but registration happened after 4 years. Correct. Aditya, you are right. 2 houses, limit is 2 crore only. Right? I purchased a house within 2 years, but the registration happened after 4 years. I don't care. Possession is the criteria. Similar to TOPA, transfer of property. Hidden points and exemptions. I've given all hidden points in one thing. Right? I had a joint property worth, I had 1 house property, I sold it. I got 1 crore. I had one more property worth 2 crore. This belonged to my bro. I am Mr. Ambi. I already own 1 crore here. I came to my brother Anyan and said, Anna, please give me this your part also. Anyan said, hey. Ambi said, I'll give you Nandini. Huh? Okay, take it. Anyan gave this part also to the brother. Now tell me guys, is this acquisition of new house? He already owned 50%. 50% he bought. Is it acquisition? Answer. Went to court. Issue went to court. Issue went to court. What did court say? See, release of share in house property by co-owner in favor of the assessee amounts to acquisition. Deadly. Because in the Bear Act, no, new house property is not there. CA final will discuss. This is important for inter, but in Bear Act, new house property is not there. It just says another house property. Are you understanding? So even if it's old, 50% if I buy, it is valid. Yes or no? See? Consideration is involved. Correct? Now I bought, in the apartment, in 1 floor, 2 houses were there. I bought this. I removed the wall, made it 1 house. 1 house or 2 houses? One house or 2 houses? I bought 2 flats, removed the wall, made it into 1 house. But when registration, 2 separately I will register. But internally I made it 1 house. 1 house or 2 houses? This also went to court, see? All these are court decisions, important for the exam. 2 flats acquired by assessee which are adjacent to each other can be considered as a single house. See, deadly. Are you living in 1 house only? Yes. I just combined. Joint family is there. Joint family. Why? I want 2 houses, I convert to 1 house. 1 house or 2 house? 1 house. One house I had. One more floor I built. Is it one more house? Answer. See, all this they can ask tricky questions. One house I had. One more floor I built properly, neatly. One more floor. Is it one more house? So if you see, yes. Yes. It is a yes. Where residential house is sold and capital gain is invested in constructing the first floor of another residential house already owned by the assessee, exemption can be availed. Extension of existing houses also permitted. See how it is. That's enough for revision. I mean, in this particular chapter, it's fine. I mean, this particular concept. Can I do 2-2? Can I invest in 54 also and 54 EC also? What do you think? My capital gain is 60 lakhs. 10 lakhs in one house, 50 lakhs in 54 EC bonds. Answer. Yes. Why not? If it is possible, it is possible for an asset to avail exemption in more than one section. Yes, you can do it. You can do 54 EC combination, no problem. Right? Yeah, you can do. This is the full summary already discussed. Leave it. Last part of the revision, 10-15 minutes. We'll finish it off. This is the next part, guys. What is this? Capital gains on long-term assets and all those things. 112A. Right? Special rates. 112A is applicable to equity share, unit of equity-oriented fund, unit of a business trust. If STT is paid on that is security transaction tax, it is paid. Basically, it is all the shares traded in a stock exchange. Then, on the amount of long-term capital gain under 112A, up to 1 lakh, nil. No capital gain for 1 lakh. Exceeding 1 lakh, 10%. On the amount of total income after reducing long-term capital gain, the tax payable at the normal applicable rates. And to that you will add surcharge, health education cess and all those things. And basically you will long-term capital gains computed under 112A shall be reduced by the basic exemption limit and the balance shall be taxed at 10%. Very simple. Since it's a very less rate of 10%, there is no basic exemption limit that you are getting. Example. Mr. A, resident 65 years, derives taxable pension and interest income of 2 lakhs. Also derives long-term capital gains 5 lakh. For a 65-year-old fellow, what is the basic exemption limit? 3 lakh. Overall, how much it is? 7 lakh. Will you do 7 lakh minus 3 lakh? No. For capital gains, you will not get basic exemption limit. You can only claim basic exemption up to 2 lakhs. So tax on pension and other income nil, as the taxable income does not exceed the basic exemption limit. Unexhausted basic exemption limit is 3 lakh minus 2 lakh, overall 1 lakh. Remaining 1 lakh, what do you think? So you see that 1 lakh is the unexhausted portion. Will I get the benefit of that? Yes, see. In this case, the basic exemption limit available to Mr. Y is 3 lakh. Being a resident senior citizen, it is not fully exhausted. The unexhausted basic exemption limit of 1 lakh shall be reduced from the long-term capital gains for applying 10%. So, income from long-term capital gains is what? 5 lakh. Unexhausted basic exemption limit benefit is given. Initially, they had taken it away, then they gave it. 1 lakh. Balance capital gain under 112A, 4 lakh. Tax up to 1 lakh is anyway nil. The remaining 3 lakh is taxed at 10%, 30,000. Always we should do like that. First, basic exemption limit we should remove from other income. Whatever is the unexhausted portion, that you should subtract from the capital gain here. And whatever you will get, again 1 lakh is the other exemption you will get. Because if you see here guys, tax up to 1 lakh is nil rate. Tax up to 1 lakh is nil. You will not be charged any rate anyway. Got it? But if they ask you non-resident, most important, then the benefit of availing basic exemption is not applicable. Most important. Mr. Sam, age 58 years, non-resident, earns 5 lakh as non-term capital gains. So section 112A, 2 lakhs as taxable pension and interest. In this case, entire LTCG of 5 lakh shall be subject to 10%. As regards other income, no income tax is payable since income does not exceed the basic exemption limit applicable to non-resident individuals. So for this basic exemption limit benefit for capital gain is not applicable to a non-resident. Similarly, one more important thing, rebate under 87A is also not applicable for LTCG under 112A. All these hidden points. For example, tax on other income 3,500. Tax on LTCG 6,000. Total tax 9,500. What is the rebate? Total tax or 12,500, whichever is less. So you will take 9,500 and make it 0. Wrong. Rebate is applicable only for this. Balance tax is 6,000. You need to pay. Next, let's see. Short term 111A. Short term capital gain arising from equity share, unit of business, whatever it is, STT is paid 15%. 15%, very simple. But on other than long term capital gain, other than 112A, other than that equity shares, etc., taxed at 20%. Tax at 20%. Similarly, basic exemption limit is not applicable to non-residents. In case a non-resident earns 60,000 as long-term capital gain and 1,50,000 as interest income, entire sum of 60,000 shall be charged to tax at 20% plus health and education cess. As regards other income, no tax payable for non-resident. So summary of tax rate, same thing. Resident individual HA of 20%. Can you avail unexhausted basic exemption? Yes. Resident AOP and BOI 20%. Can you avail? No. Resident firms and LLP 20%. There is no concept of basic exemption limit there. Domestic companies 20%, not applicable. Non-resident and foreign company 10% or 20%, no. So in case of transfer of security under 112, it is other than units and ZCB. LTCG would be 10% without indexation benefit or 20% with indexation benefit. Short-term capital gains other than 111A will be charged at normal rates. So all that we have seen, cost of acquisition, different scenarios, everything we have seen this. Some other important points. Let's see. Cases where indexation benefit is not allowed, short-term capital assets, long-term capital assets, bonds and debentures, except capital index bonds and sovereign bonds, slump sale you will not get. And wherever I have invested 10% without indexation, I will not get indexation. These are some of the important points. I'm just revising. On amalgamation, all this you leave. This demerger and all quickly, it's fine. 222C yesterday only we have discussed in the IFOS point. Leave it. Last part. Computation of capital gains in depreciable assets. PGBP versus capital gain. There must be at least one asset in the block Important rule. There must be some value of the block left. Very important. Guys, the moment an asset goes into a block, asset will cease to exist. This block will be there. Assets, if assets are existing, everything will be within the block only. But if everything is sold, then capital gain will come. One asset should be there, but if others are sold, capital gain will come. Capital gain will always be in the nature of short-term capital gain. See here, in case of block of assets, depreciation at 32 can be claimed on the written down value if two conditions. So depreciation at 32 will come if at least one asset must be there. If one asset is there, block is still there. And there must be some value. There is some value, but no assets are there. Capital gain. There are 5 assets, but no value. Capital gain. Examples. See? There are 8 assets in an existing block which has an opening, opening WDV, not WIP, opening WDV of 8 lakhs. 2 more new assets were acquired during the year which had an actual cost of 3 lakh. Check it out. Opening WDV 8. Add the actual cost of assets 2 more, 3 lakh, total 10. All 10 assets were sold for 12 lakh. See, all 10 were sold for how much? 12 lakh. What is the condition for depreciation? At least one asset must be there and some value. In this case, no assets are there. Value also is not there. So, capital gain will come. So, if you see, full value of consideration 12 lakh. Cost of acquisition 11 lakh. Short term capital gain 1 lakh. Next. All 10 assets were sold for 10 lakh. 8 lakh, 2 lakh, 10, 10. So, value is there, but assets are not there. I repeat, if it has to stay in PGBP, minimum one asset must be there, plus some value must be there. In this case, value is there, assets are not there. So, what will it come? Capital gain. 10 lakh minus 11 as short-term capital loss. Third case, 6 assets are sold. In this, assets are remaining for 12 lakh 50. 11 lakh is the final WDV, 12 lakh 50 it's sold. Assets are remaining. Value is not there. Capital gain. 12 lakh 50 minus 11, 1 lakh 50. Last case only. Assets are also remaining. Value is also remaining. For this, it will continue in the block. Very, very important. So, revision. In case 1, assets is not there, WDV is not there, hence depreciation will not come, capital gain will come. Second case, assets are not there, but WDV is there. Still depreciation will not come, this one. Third case, assets were remaining, but value was not there, depreciation will not come, capital gain. Only in the last case, assets also remaining, WDV also remaining, depreciation will come, capital gain will not come. On that note, my dear friends, within 2 hours, we have completely revised. We have completely revised what? Capital gains. Whatever is required for the exam, quickly. Like simply like a marathon. It is not even the full thing, right? Many things are there, but you cannot sit and do everything, right? Hope you are able to understand. Right? Thank you so much, guys. Thank you. Love you all. Take care. Come on. Fist bump.